Okay, let's move on to the second tax planning mistake that business owners make. The failure to maximize on pension, 401k, retirement plan contributions, and minimize related costs for your employees. I learned when I first got out of college, the best tax shelter for business owners is your retirement account, your 401k plan. We used to have a defined benefit plan that now we've kind of gravitated away. One of the magical plans that are out there for business owners that are successful in their 50s and 60s and they're making their hay is what's called a cash balance plan. You're allowed to take your 401k and you can put what's called a cash balance plan on top of it, and without increasing the contributions significantly for your rank and file employee, you're able to significantly increase your contributions to the business owner. And that's what most business owners want. How do I get more money into my retirement account, save taxes at least a third? It depends on whether you don't save Social Security taxes on, if you're a sole proprietor, on the money going into your retirement account. But if you're an S corporation owner and you're an employee of a company, then you do get the benefit that you're able to avoid Social Security taxes. But I think that's something that every business owner should be looking at. And the question to ask, quite frankly, is how much do you want to put away in a plan the next 3 years? How much can you afford to put away into a qualified plan? That's what drives the plan design. Sometimes you might only need a simple IRA instead of a 401k. Or you might need a SEP. These are terms of art. These are different types of plans. So it's kind of like you got vanilla, chocolate, and strawberry, and each one has certain benefits. So you want to work with someone that's experienced in designing a pension plan to evaluate what you want to do. And the starting point I look at is how much do the business owners want to put into the plan? How much do they want to shelter? If they wanted to maximize putting money away, knowing that they're going to be saving taxes along the way. Now, you might hear of people that recommend a Roth account, a Roth IRA. And I think that, to me, the question I would raise to you is, do you believe you're going to be paying taxes at a higher rate when you retire than today? That's the question. And when you think about that, most people I know, I'm talking about the average people, they're lucky to get $1 million into a retirement account, okay? How much income are you going to get out of a retirement account a year? Your required minimum distributions might be $40,000, $50,000. That's ordinary income. You got Social Security. Are you really going to be in a higher tax bracket when you retire? Even with the Trump tax reform. So the message I have typically for the average person is you don't need to be in a Roth IRA. It's a scam. But what happens is that, in fact, they have changed it that some companies have Roths, but typically most companies do not offer the Roth alternative to the 401k plan. So financial advisors are out there saying you got to roll your money over into into an IRA, and we'll do or they want you to do a Roth and put money away into their Roth IRA. Okay, and it's just something that I would say that you should evaluate very carefully with your financial advisor, and it's a matter of your crystal ball. And sometimes you say, well, maybe I might be in a higher tax bracket when I retire. I don't believe that, quite frankly. Okay, and what's happened over the years, all these tax brackets have been indexed with inflation, and they're going to continue to do that. So these tax brackets we're looking at, those brackets will continue the lower brackets will continue to spread out over the next 10 years, so that you're not going to be, the rates are not going to be going up on you, is what I'm trying to say that much. Any questions on retirement accounts? The one thing I'm going to comment on that in the past, that this is one of the big changes, it's going to affect the elderly. Elder law planning, we do a lot of estate planning with clients that are going to the nursing home. Most of the people in their 70s and 80s might have $500,000, their house, and some investments. They typically have had an IRA that they've rolled over their retirement accounts into. One of the big advantages we had when someone was going to a nursing home is that they could take the money out of the IRA account and they get a medical expense deduction, so that they had all that money available to pay the nursing home. Now, the rules with the medical deduction on Schedule A as an itemized deduction is you would have to pay tax on 10% of your income, but you would get a tax deduction for Kentucky and federal purposes as an itemized deduction, your medical expenses for the nursing home. And I've had to go through this before. Now, what's going to have to happen is the person in the nursing home is going to have their CPA compute how much taxes they owe on their IRA account that they're using to pay for the nursing home. So they're going to lose a quarter, 25% of it, whatever that number is. It depends on how much the income is. It could be 20% between, if it's a lower tax, if it's the 12% bracket or the 25% bracket they're in. But nursing homes are $60,000, $100,000 a year. So you're going to have to take out, what I'm saying is that used to be you could take out $100,000 and have 90 available for the nursing home. Now you're going to have to take out probably 150 to have 100 left with the nursing home. Okay. So these are some hidden things within this law. It just got proposed. I've been a silent advocate of the IRA and not the Roth IRA because they never talked about that. And I always found that, I've observed this over the past 40 years I've been practicing as a CPA in taxes. Once Congress hears about what's going on, then they change the law if they think it's a loophole. Okay? So I always try to keep that under the radar, but we always work with clients doing elder law planning, trying to identify when should they take money out of the IRA account. Now, what you would do in this situation, quite frankly, is the opposite now. If they change the law and take away the medical expense deduction, you're going to use all the other assets that pay for the nursing home, and the IRA will be the last thing you spend because then you can do a rollover to your children or family, and they can spread the tax out over their lifetime. So what I'm trying to say to you is that once we find out what the law is, then that'll be the plan. You'll shift it. Instead of cashing out the IRA and taking advantage of not having to pay any tax on the IRA, we'll defer it and we'll use the other assets for the nursing home.